I'm Charlotte McLeod with investingnews.com, and here today with me is Andy Schectman, president of Miles Franklin. Thank you so much for being here. Great to see you.
Charlotte, it wouldn't be a conference unless we were here doing our interview together. It's great to be back with you.
Yes, really nice to have you here in person. We are at the Rules Symposium, and we've made it a couple of days into the event. So I want to start with any takeaways you have from conversations you've been having, themes you've been noticing here.
I mean, to me, the one overriding thing that I noticed that's different than all of the conferences I've been to in a long time is a new group of people. I mean, you go to these shows long enough, and there's two that I go to, and I see you at both of them. I go to Jay Martin's Vancouver Resource Investment in your backyard, and I go to Rick's here in my backyard. They're the two that I go to. The two I wouldn't miss, and I've been going to both of them for a very long time. In fact, since this conference was in Vancouver as well, way back when, under the Agora flag. But you see the same people you see every single year, and it's a very small community. It's expanded quite a bit. This show was sold out months in advance, many of which are new people in the space. I find that very encouraging. And, little by little, we're seeing an expansion of awakening into more of a mainstream, which is really yet still not quite gotten this. But that, to me, is what's different more than anything else.
What do you think is drawing in that new crowd of people? Is it those high gold and silver prices that we were seeing toward the end or beginning of the year? Or is it more an understanding of what's behind those price increases?
Yeah, I think that's the bigger issue. It's not the prices. Prices are a tool of misdirection. That was the name of my presentation today. Prices misdirect. And I think instead fundamentals should be driving everything. Problem is the fundamentals are blurred and hidden by the mainstream, who really don't talk about what's happening. I mean, I'll give you an example. In the month of June, we saw $14 billion worth of gold delivered on COMEX. $14 billion delivered on COMEX. Now, not all of it left the COMEX market. It doesn't matter. This is a market that was typically predicated on for decades on the belief or understanding that investors wouldn't stand for delivery. They would cash settle, they would roll forward, or they would exit the position. It was done to hedge, not to speculate, largely. A miner, as an example, here at the conference, who has their production coming due, will forward sell it on COMEX to hedge. They're happy with the price, they'll hedge it. Or a company like mine who has 2 million ounces of silver in a warehouse to sell will hedge the 2 million ounces. I'm not going to stand for delivery. I'm using it to offset risk. And when the inventory is sold, then I close out that position. So what we're seeing now is massive deliveries. And it's been going on for 18 straight months. In February, we saw 4.1 million ounces of gold delivered for almost $20 billion. For 18 straight months, every single month, it's delivery, which is so far an outlier to anything I've seen in 35 years, and nobody on the mainstream talks about it. So the public doesn't quite get it. I think it's less to do with the price of gold. In my mind, as someone who's watching it from this side, it's all about deliveries for the most informed players in the world. But for people who are here for the first time, it's not that. I think it's a general sense of being uneasy with what's happening around the world. A lot of times you can't even articulate it. You feel this charge in the air that is uncomfortable, whether it be with what's happening geopolitically, wars around the world in particular, in the Ukraine and in Iran. Maybe it's fiscal irresponsibility. Maybe people see that the dollar isn't going as far as a result of inflation. Things are getting more expensive. I don't know. I think there is an awakening largely because it just seems that for the last 6 years, everything's been a little inside out. Everything isn't just quiet and normal like it used to be. In fact, it just seems like every other day there's some event that just makes people stand back and take notice. Maybe it has something to do with that it's more about defensive posturing, looking at something that is often looked at as insurance, taking a look at it and opening your eyes to something other than the belief that the road to retirement is simply funded with mutual funds and stock certificates. And you look at the positioning on the S&P 500 as an example, you have the entire market being held up by 10 stocks, and that's generous. It's more like 7. And at some point, you have to realize that, maybe this isn't super healthy, so maybe I should take a look at putting a little bit of money on the sidelines or into something more of a risk off and like precious metals.
Yes, I think there's a lot of things under the surface that could make somebody feel like things are not quite right. And I like your theme of price as misdirection. I think we can maybe unpack that a little bit more because even at this event, I do find there is a lot of focus on price. Maybe people see this as more of a buying opportunity right now with prices lower, but there is still questions about, well, why are they lower? What is going on? What's wrong with gold and silver?
And the big money doesn't care about price. The Bank of International Settlements came out in February and commented on the price slam. And they said, look, this wasn't fundamental at all. This was structural. A lot of things happened at the same time. At the end of the year, typically at the beginning of the year, rather, you have what's called ETF rebalancing. And ETFs that have gotten way out of whack, they have to rebalance according to their prospectus. Well, silver and gold have been going straight up month over month over month over month, or week over week for sure, into the last several weeks of the year. The ETFs got way out of whack. They had to be rebalanced the first week, and it's a notorious time for commodity-backed ETFs that must be rebalanced. There's going to be selling, or in some cases purchasing. In this case, wicked selling. But the BIS more or less came out and said, which is the Bank of International Settlements, the most powerful bank in the world. They said, no, this was synthetic. This was structural. This wasn't fundamental because not only do the ETFs have to rebalance that first week, the CME group, which is the COMEX in their infinite wisdom, decided to hike margin rates by 300% into that event from early December until first week in January or so. Margin rates went up 300%. And that means that's the money you have to have as collateral inside of your account in order to speculate on these contracts. Now, if you're someone like myself or a mining company hedging, you still have to have the collateral up. If you're a speculator, same thing. To give you an idea what I mean by that, we'll typically have 2 million ounces of silver in our warehouse, and in early December, it was roughly $15,000 to hedge 5,000 ounces. I'm a speculator. I want to buy a silver contract that's 5,000 ounces, 5 1,000-ounce bars. $15,000 approximately in your margin account, collateral just sitting there. Through a series of incremental increases by the first week in January, that was $54,000. If you didn't post that money every time they raise margins, they would liquidate you within 24 hours. And the cost, if you had $110,000 in your margin account in December, that would allow you to buy 7 contracts. By 5 weeks later, those 7 contracts cost you 300% more. And if you don't have that money in your account, you're talking, $350,000+, you're liquidated, which selling begets selling, begets selling, begets selling. At the same time, the ETFs are rebalancing. Silver had gone straight up. Selling begot selling, begot selling, begot selling, and the margin increases, selling, selling, selling. And as they sell, all of the stops along the way are triggered. Begets more, gets more. Okay, so one would think that the price was collapsing. That means demand was collapsing. As that happened, as an example, China bought more silver in the first quarter of the year than at any time in the history of the country. In February, that says the price got destroyed. They bought $54 billion worth of gold the first quarter as the price got destroyed. In February in the United States, 4.1 million ounces of gold delivered as the price got destroyed. That's $20 billion worth of gold. Someone stood for delivery, 5,000 an ounce, or pretty damn close to it. Even 4,500, call it 18, 19 billion, delivered as the price got kneecapped. Same month, which was a non-delivery month for silver, primary delivery month for gold, about 26 million ounces of silver were delivered, still very significant, but 39 million ounces got on trucks and left COMEX that month. That's 160% of what deliveries alone could explain in the month of February. That's 2.9 million pounds of silver worth almost $3-4 billion that got on trucks and said buy. Now, who did that? Who loaded the trucks? Who ran logistics? Who put insurance on all this, and where did it go? Who stood for delivery for nearly 20 billion worth of gold? Who did it this month for 14 billion worth of gold? And a lot is leaving, a lot is staying. When it stays, it moves from registered, which is the category that the bars are backed off of. In other words, the contracts say if you want to stand for delivery, that's registered. Eligible is an account whereby they could move to register, they're eligible to be registered, but they're not for sale. We have 9 BRICS locations throughout North America that we have a storage program with. One is in New York. It's the only one that is a BRICS, is a COMEX location. The rest of the BRICS vaults are not COMEX. This one happens to be. I have one client in particular that has 2 million ounces in 1,000-ounce bars at that location. It's ineligible. It's not registered. If she wanted to move them to registered, she could, but she has no intention of offering these to COMEX. So my point is, when the metal gets delivered, just because it's ineligible in the eligible category and not getting on trucks and driving away, like a lot of it has, doesn't matter. It's still being physically delivered where, you know, like I said, the assumption forever was that no one would stand for delivery, that they would roll, they would settle, they would exit. Now they're saying, nah, I want the real bars. I want them in the numbered bars, and I would like them in my possession. Thank you. And if and when they leave, it wouldn't surprise me. But it's just one of these deals where I think you're beginning to see that delivery is being prioritized over paper promises. And that's a big deal because it's never happened before. It's a very big deal because ask yourself, for 18, 19 straight months, who the hell's got this kind of money? Who the hell's got $14 billion in June? As the price is doing nothing but disappointing. But all of these massive accumulations, whether it be central banks around the world, Poland, who's bought more gold than anyone in the world, with the only one who's even been close to them is Tether for the last 2 years, believe it or not. But all of these, Poland or China or India or any of these countries, how about France repatriating all their gold from the New York Fed, or India repatriating all their gold from the Bank of England? They would do that because Bank of England is attached to the LBMA, and New York Fed is attached to COMEX. But this follows the Dutch National Bank, the Bundesbank of Germany, the Bank of Austria, Hungary, Turkey, the Polish National Bank, the Czech National Bank. All of these banks said to the West, we'd like our metal back. We'll forego the convenience of the COMEX or the LBMA. We want it back. But that goes on top of 3 years in a row of 1,000 metric tons or more being purchased by the central banks. And they're a bunch of liars because they told us first quarter of this year, which by the way was the largest first quarter ever in history of central bank purchases, that they only purchased 16 tons. The World Gold Council says, no, it's 15 times that much. What are you talking about? 15 times that much. So they're like it's 160 tons or whatever the number was. Whatever 16 times times 15, that was the number they came and said, you've underreported by 15 times, 200 and whatever. The point of it is that the central banks have been buying in what is an inelastic manner. They don't care what the CPI is. They don't care what the employment numbers are. They don't care what anything is. Every single month they've been buying, and they're using the price to misdirect. And the fact that no one has the integrity in the mainstream to say, who the hell has stood for delivery? Again, every month, Charlotte, for 18 or 19, since Trump won the election last November, every single month there's been between 9 and 10 figures of gold and silver delivered. Who's doing it? Why does no one ask? And it is so far outside of what is normal. In the 35 years I've done this, less than 1% of any of these contracts stood for delivery. But that narrative is being rewritten in a very, very, very big way, and it's being done so very quietly, and no one's talking about it in the mainstream, and that's why the public just doesn't get it.
Really good overview. So we've got this massive emphasis on physical delivery, and I'm hoping we can hone in on what's going on in China.
Sure.
I've been hearing at this event people talking about recent measures China is taking, again, to emphasize the physical market. So I wonder if you can hone in on what's going on there, what we should understand.
Well, it's across the entire global south. You have new exchanges that are settling price in Dubai, in Singapore, and in Hong Kong. Now, really, the only place that ever set the price was COMEX and the LBMA. Now you're getting Hong Kong saying, we're going to set the price, and we're going to do it in a manner that will challenge the West specifically. Singapore and Dubai, these are 1 day or less instant settlement markets. So where instead of buying a futures contract that you can do months in advance, where the tail wags the dog, in other words, the central bank set the floor and the trend the daily movements is set by the COMEX and the big banks that play the game, and it's distorting the real value. It's distorting the real price. And if price was a tool, I mean, if price was a measurement of value, then who the hell's standing for delivery as the price is getting kneecapped? And so the point of it is that the rest of the world says, well, we're going to build an infrastructure to challenge it. And the reason that these countries aren't pissed off and more vocal about it is they're the ones accumulating it. So if we're stupid enough to suppress the price on paper, well, they're going to stand for delivery. Look at the numbers, the export numbers to China. They're off the charts. China's been buying nonstop as we're stupid enough to suppress the paper price. Why wouldn't they? In fact, they jump into the game too, but it's getting to the point where open interest on COMEX is so low, that means there's not as many ready and willing and able players to take the other side to short the market after all of the nonsense. In other words, it's like a lot of the players that you would normally find on COMEX have picked up their toys and they're going to a different sandbox. Are they moving to Hong Kong, to Singapore, to Dubai? Yeah, I think a lot of them are focusing their interest there. There's a rumor, and I think it's pretty substantiated, that JP Morgan's largely, their metals desk moved to Asia. That is where things are moving to. What is really different about it is that they are settling. And this is, in essence, not metal moving from west to east. It is the infrastructure of a paper-settled market moving to a much faster, non-dollar-based market, deliverable in Asia. And it's very relevant in Hong Kong that not only have they built a new metals exchange where you can take physical delivery for things like digital yuan, which is the premise of all of the rails being built, whether it be the CIPS, the Cross Interbank Payment System, or the M-Bridge, that are allowing countries to trade with one another, or to trade with one another using their local currencies, settling imbalances in gold. That's what we see happening. But what's really relevant about Hong Kong is that when gold leaves China, it has to leave out of Hong Kong, has to. So you now have a vault there, but they're doing it where price will be settled there. Instead of it being only settled in the West, they're now going to settle it in the East, where you could argue the emphasis is on reality there, because it's, give me the gold now, that's what it's worth. Not, I'm going to buy a futures contract, and in fact, I'm going to sell a whole bunch to drive the price down. And all of the nonsense that we see with paper contracts largely would be curtailed if price is settled in the East, and that's what we're seeing. It's a very big deal. The rails are being built where all of these vaults will connect, and they will connect to the Cross Interbank Payment System. They will connect to the M-Bridge, so everyone's trading but settling imbalances in gold throughout an expansion, largely of the Shanghai Metals Exchange, who plans on building exchanges all throughout the Belt Road into Switzerland, Dubai. We've already talked Hong Kong. We've talked Saudi Arabia. All of these exchanges are being built right now or already built to do this. And the part that most people have a hard time with, even those that understand gold, is we live in a society where instant gratification is too slow. And if it's a regimented, drawn-out process like the Chinese have become experts at, and you can see it if you look, it's incredible what they've built already, these folks, not just the Chinese, the global South. It's dismissed, but I'll tell you it'll be a very big mistake, because what China just did, and it's interesting, China turned on the switch this week, so last week was Singapore, and the week before that was Dubai. All three of these exchanges will challenge ultimately the West, but they will be arteries of a new system connected through payment systems that are not compliant or not compatible with SWIFT. So you trade with one another. I'm going to strengthen my economy. You're going to strengthen your economy, not the United States. We're not going to have to strengthen their economy by holding their dollars. We're going to use our currencies. We're going to strengthen our countries, and then we'll settle imbalances in gold instead of holding treasuries. That's where things are moving.
I wonder if you can share an update on where the BRICS are in all of this. We've talked a lot about the BRICS in the past. I know you do a lot of work. It seems like they've gone a little bit quiet lately, although maybe that's because I don't know where to look for the information.
You're right.
I know there's a meeting coming up, so what will you be watching?
It's quiet largely because what happened last time they weren't quiet. M-Bridge, which is the cross-border payment system, was developed by China, Hong Kong, Thailand, UAE, and then ultimately Saudi Arabia, along with or in conjunction with the Bank of International Settlements, what's it called, Innovation Hub. So the BIS, which is a Western institution, decided to help. And at the 12th hour 2 years ago, as they were going to roll it out in Russia, Augustus Carstens, the then acting general manager, said, you know, we have to pull out. BIS is out. We're pulling the plug on it because we can't be involved in any payment system that would allow countries to sidestep Western sanctions. It's as if they just realized Russia was the R in BRICS and pulled the plug. It was done in what I felt was like espionage. It was James Bond. It was right in your face. It was done specifically, and it really aggravated the BRICS. Really aggravated them. So what they are doing now is everything that they would otherwise be doing, but they're calling it the expansion of, or the internationalization of the yuan. All of the vaulting systems that Shanghai is building, like Hong Kong, like Saudi Arabia, like UAE, and then ultimately into Zurich, and then throughout the Belt Road will be, like I said, the arteries that will connect with all the other vaults in Mumbai and in Brazil and in St. Petersburg and in Moscow and the BRICS vault itself. They will all connect. They're doing it to not antagonize President Trump. That's why they're doing it quietly. And I don't blame them. The West screwed them at the 12th hour. And, you know, Trump has talked a lot about BRICS, but he's not going to say anything about Xi wanting to internationalize the yuan. But these are the rails of the BRICS nations. And so it's still there, and it's still growing, and it's still real. They're just not going to be as forthright about it, not as open about it, and I don't blame them. But no, again, to dismiss that would be a very big problem because, like, for example, they just launched Enbridge. It's now operational. This is the BRICS payment system where it's central bank to central bank, and they haven't let loose the unit currency yet, which is 60% BRICS plus countries, 40% gold, deliverable through these vaults upon demand by a central bank. Right now they have BRICS Pay that is in the midst of being disseminated through the Belt Road Initiative. That's, I don't know, 50, 60, 70% of human population, 40 or 50% of global GDP before industrialization, and BRICS Pay is like a system, like a credit card or an app that allows anyone within a BRICS country to purchase things from another BRICS country or in a BRICS country without having to convert back and forth between currencies, just like that. But it's not connected to Visa, it's not connected to MasterCard, it's not connected to the SWIFT. All of these little moves that are being done to no longer settle as many trades or purchases in dollars chips away at the dollar settlement status. And if you don't hold as many dollars, you don't need to recycle as many of them that you don't have back into treasuries, which chips away at the reserve status. So BRICS is moving, and it's moving in a very plotted fashion. But you're right. I think that they felt being forthright and open and trying to integrate with the West like they originally had intentions of doing would be a very big mistake. Now they're just being a little more quiet about it, but you can see things are moving along. And I think, depending upon what the next administration is, you'll continue to hear about them until they reach that point where then they can actually be legitimized enough to be an alternative to the dollar. It doesn't have to displace the dollar, but it certainly can be an alternative, and you can see it right now. All of these countries are saying, you know, screw it. I don't need to hold U.S. treasuries that can be taken and sanctioned, and holding dollars that are being inflated away is stupid as a mud wall. So let's build our own monetary ecosystem. Let's benefit our people, our country. We'll trade with one another. We'll settle imbalances in gold instead of treasuries. And by the way, gold is 10x the treasury market in the last couple of years. It's doubled it over the last 25, or the 10-year treasury. So who would want to hold a long-dated treasury in a country that has chosen inflation over austerity forever? If they raise rates, the whole thing blows up. So they can't. They're going to keep rates low as long as they possibly can and accommodate. And that's bullish for gold and not great for the treasury. So I guess we'll see what happens.
That approach, it definitely does make sense the way you frame it. And I know we've got to start wrapping up relatively soon, but I want to throw in one more question about the West and Trump. We're speaking just a few days after July 4th. I know that many people in the gold industry were looking at that date in terms of, are we going to get an announcement out of the U.S. potentially involving gold, which it seems like we did not. So any thoughts on that? Is that something that could still come?
Yeah, I mean, look, I interviewed Judy Shelton twice on my channel. I read her book, best-selling book, Good as Gold. I watched 1 million of her interviews. She was Trump's nominee to run the Fed. She's brilliant. She said to me, Andy, you know, when I was part of the transition team, in no uncertain terms did Trump say to me, July 4th is the biggest day of his career or of his presidency. It's the 250th anniversary of the country. And we discussed him issuing 50-year gold-backed treasuries as the first. In her book, she says 5, 10, 20, and 30 after, but to reinstill confidence in a system that has lost it, whether it be through weaponization against Russia and Iran or just flat-out fiscal and monetary irresponsibility. And so, look, I was asked a few weeks before, what are the chances? I said 50-50, and I based that upon Judy Shelton. I said it was her idea. I was bummed when it didn't happen, but look, you got a G20 meeting coming up at the end of the year. There's 1 million opportunities for him to do it. I will tell you this unequivocally, whenever you go out on a limb and mention a date, a specific time frame, invariably you end up disappointed. There's no upside. July 4th was a bummer, and look, you know, when you take all of the things around us, you got Scott Bessent earlier saying, I'm going to remonetize the balance sheet of the United States. You got Trump saying it's the golden era. You know, you got Judy Shelton saying his advisor, his nominee to run the Fed saying, yeah, July 4th, we've talked about it all the time. When you see all the gold being delivered on COMEX, when you see all the gold that is being accumulated by the global south, it just made sense. And I will tell you, I think it was the best idea I've heard ever. To date, I would say, to date, it is the best idea I've heard. And I think it should happen. And I think it might happen. Should it have happened July 4th? Well, that's what we all wanted, and that's what Judy thought it would. That doesn't mean it's not going to happen. I don't think a gold revaluation is something that we should all count on. Maybe they market to market, as they should. They should at least market to market on their balance sheet, which would give the Treasury General Account $1 trillion free and clear. That's the accounting. But, you know, the fact that it didn't happen July 4th was a bummer to the industry, but again, I don't think it's the end of the story. It's just another series of slight disappointments for people in this industry. But, you know, through it all, gold and silver seem to have found a way to outperform almost everything since I've known you. And there's been bumps in the road and volatility and white knuckling and nauseated counterintuitive price action for a long time. But in the end, it's like the tortoise finds a way to get to the finish line before the hare. I'm not saying that happens all the time, and I want to make it clear, you own gold and silver not to become wealthy, but it is wealth that has outlasted 2 world wars and German hyperinflation and the Great Depression and every pandemic and everything, and here we are 6,000 years after it was named 700 times, or they, gold and silver, cumulatively, were named 700 times plus in the Bible, and the most well-informed and well-funded traders on the globe, whether it be the central banks, who have bought for really 9 years in a row, but are escalating those numbers and not being forthright about it, called out by the World Gold Council, or whoever's standing for delivery in billions every month, gold and silver, these people seem to know where the puck is going. And I think that's what they're doing. They're skating to where the puck is going, not where everyone sees it right now.
Well, I think that's a great place for us to wrap up, unless you had any final brief thoughts to leave with investors.
Yeah, that's good. I think the most important thing is that for people to look at this as wealth and stop looking at the price. It is the greatest tool of misdirection. Look at what the biggest, most well-funded and well-informed traders in the globe are doing. Central banks, the commercial banks, and whoever is standing for delivery here. The delivery betrays the price. The delivery betrays everything, because if it was just about price, then the central banks are no dummies. They wouldn't be buying it. The Chinese are not dummies. They wouldn't be buying it. And you think as the price is getting kneecapped for the first quarter, that whoever stood for delivery for almost $20 billion in gold in February, who took 39 million ounces out of the COMEX in silver in February, or the first quarter in China, most silver ever accumulated, or 54 billion in gold. These people know what's happening, and they're using price to run cover for it. And either you see that logically and look at the facts behind it, or dismiss it. That's the tough part. And it's never easy. But I think these people make it easier by their actions because they have the information. Certainly when you're spending 9 and 10 figures a month, you would think you have that info.
Well, perfect way to sum it up. Thank you so much for helping us dig deeper into what's going on in gold and
Charlotte.
silver.
I always enjoy our time together every conference, and I'll look forward to seeing you in person in January.
Yes, I'll be ready then. Well, thank you so much. And once again, I'm Charlotte McLeod with investingnews.com, and this is Andy Schectman with Miles Franklin.